traders, and welcome to a new week in markets. Okay, so the big news in markets and what's moving markets is obviously what happened with US payrolls, US employment data on Friday night. And wow, what a number. That number blew away all expectations. So for the headline number, the market was expecting plus about 160,000 new jobs added. And the actual number came out at a whopping plus 250,000 new jobs. So that was well above 100,000 above expectations. Absolutely fantastic number. Unemployment rate as well did exceptionally well. So market was expecting that to remain steady at 4.2%, and that actually dropped down to 4.1%. Look, the only way that you can sum up a number like this is that the US employment market is exceptionally solid. It is going exceptionally well. So look, that does have a lot of meaning for markets. So let's have a look at the market impact. Okay, so two of the markets that we have talked a lot in these market updates, and the two markets that have been trending exceptionally well for the last few months, that's US bond yields and the US dollar. So starting with US bond yields, US 10-year yields were trading just sub 4.7% before the number. They spiked up, as you'd imagine, on such a fantastic jobs report, and those US 10-year yields went almost as high as 4.8% and settled just a little bit lower. But what we did do is we took out the high in US 10-year yields for 2024. That was sitting at 4.74%. So certainly in the first couple of weeks of trading this year, these bond yields have already taken out last year's high. So market now, no doubt, the next target topside is the 2023 high, which is 5%. And which is also a big psychological level for markets. So certainly need to keep an eye on what is happening with these bond yields. US 2-year yields as well obviously spiked up. They were trading around about 4.25% before the number, spiked up as high as almost 4.4% post the number, to settle just a little bit below that. So what's meaningful here is the fact that we have a Fed funds rate that is at 4.25%. Now we have 2 yields that are actually trading above Fed funds. This is not something that you usually see in a cutting cycle. Generally you would see these US 2 yields still trading below where the Fed funds rate is. So that is certainly the market looking at the Fed saying that your rate cuts are pretty much over. So look, that is a big deal. And no doubt if those US 2 yields keep going higher, and God forbid if they go anywhere near 5%, that's actually the market saying that potentially, the Fed needs to start hiking again. But anyway, that's a story for another day. What we do see following these US bond yields very closely is obviously the US dollar. The US dollar has been on an absolute tear the last couple of months, just like the bond yields. And again, when we saw that fantastic number, that's provided a bid for the US dollar. And we're seeing the dollar index, trading up towards that 110 level. So a couple of months ago, that was down at near 100. So I would suggest if you are trading currencies, in light of what is happening in these markets, I would not be betting against the US dollar. I would not be selling the US dollar because that certainly hasn't worked, and the US dollar has very strong fundamental reasons to be doing what it is actually doing at the moment. So yes, buying the US dollar, trend is your friend. Okay, so this week is a big week in markets again. So we get some top tier US data on Wednesday, and that comes in the form of US CPI, monthly CPI data. Now, market's actually expecting this monthly US CPI number to go up again. So last month, monthly US CPI was at 2.7%. Market's expectations is that for that to go up to 2.9% And at the same time, we're looking at core inflation, which is probably what the market looks at more closely to be stable around about that 3.3%. I would suggest that post payrolls, after we saw that bumper print, the last thing this market needs is for inflation to be going back up. So to put this in perspective, inflation in the US actually bottomed with the October number at 2.4%. In November it went to 2.6, and December we saw that spike to 2.7, where it is now. And now we're looking for that to go up to 2.9. So the headline inflation number has been month on month in the last few months, in the last quarter, has been going in the wrong direction. And certainly with, again, the bumper payrolls number, you get inflation higher, that's only going to do one thing for bond yields, and bond yields are going to continue to spike higher. Market will certainly be 100% pricing out any sort of chance of more Fed rate cuts, and so that's a big deal. Is one of the reasons the market rallied the way it has is on the back of the Fed cutting rates and starting its cutting cycle. Just on equity markets, US equity markets, before we leave the US, is that they largely had ignored what was going on with the sharp rise in US bond yields. Generally, equity markets and risk in general, they basically trade inversely to bond yields higher, right? So higher bond yields go, bad for risk. On Friday, after that payrolls report, finally the US market did listen to that, and we saw S&P and NASDAQ, which have really been leading the charge for global equities, actually closed minus 1.6% on the day. They were actually down around 2% for the week. So the bond yields and stronger dollars certainly have started weighing on equity markets. So this inflation number then bears even more importance, because if that does come out as expected, and as we talked about, bond yields higher, US dollar higher, I would imagine that we could potentially get a big sell-off in US equities. So I would suggest, even though buying the dips has been working US equities, in light of that we've got inflation number coming up in the next few days this week, I'd be very cautious about buying the dip. We get a strong number there. Those bond yields, and especially if US 10-year yields want to retest 5%, and God help us if we actually go above 5% at some stage, we're going to get a lot of negative headlines out in the market, and the potential for a decent sell-off in equities is certainly there. So big risk event this week with that US inflation data. Locally also, it's an important week employment data coming out. Our market's expecting that to be around about plus 15,000 new jobs on the headline number, positive number there, and for the unemployment rate to marginally go up from 3.9% to 4%. So last month we did have a bumper employment number, which got that unemployment rate lower. So we're looking for that to go to 4%, which is still a reasonable level. Anything going below 4% is going towards full employment. So I don't think if we do get a number that came out on those expectations, that it's going to really trouble the market too much. But obviously the market is wanting to price in, and they have started pricing in a rate cut by the RBA in February on the back of the monthly core CPI actually marginally going lower. So any sort of weakness in this employment number on Wednesday certainly will add fuel and the chorus for that rate cut for the RBA in the first week of February. But conversely, if we do get a very good employment number, we'll start to maybe question whether or not we actually do get that rate cut from the RBA. Obviously, the Aussie has fallen out of bed, and it won't need a weaker number because we are testing now more than 5-year lows, and largely on the back of what's going on with this US dollar. So yes, we've got a couple of big economic data prints this week. Good luck with your trading to start the week, and we will check back in with you shortly.